What's up?
Hey everyone, welcome back to Value Invested Unleashed. Today we've got various different topics to chat about, including oil stocks, Footlocker, when to sell a stock. What was the other ones, Wes? Was it about investors being
Yeah,
misleaded? Or...
um, irrational of investors. So yeah, that's it really. You mentioned them all.
Awesome stuff. Awesome.
Okay.
So, where would you like to start off anyway?
Let's start off with the oil stocks first. You take the lead on that.
Yeah, sure. Yeah. So, I thought I'd bring up oil stocks today because unless you've been sleeping under a rock, you probably know that oil has been going absolutely crazy over the past week or so, mainly due to the Russia-Ukraine invasion. Oil supplies getting limited because Russia is a very big supplier, mainly to Europe. But everyone's just cutting ties with Russia in terms of not just government, but actual companies. I don't know if you saw this today, Wes, but the big four accountancy firms and Accenture have cut all ties with Russia. So all of their offices are just closed,
Yeah.
or they've just written off that business. But related to energy, they wanted to ban people buying oil from Russia. So which if this is causing oil to go up massively, and as a consumer, you'll see it at the petrol pump. My dad showed me a photo at tea time, or petrol pump somewhere like £1.90.
Yeah.
So yeah, oil's going up because of the supply and the demand's obviously still there. But yeah, the main point was, I think, when it comes to the stock market and looking at oil stocks, ultimately, if the oil price goes up, then the stocks are going to go up because it makes sense, doesn't it? If the product they're selling, oil, goes up, they're going to make more sales, hopefully make more profit. But you just got to be very careful because the time to buy oil stock isn't necessarily when oil's at its highest price it's been in 10 years. So you just got to be very, very careful. So yeah, I don't know what your thoughts on that was anyway.
Yeah. I agree. I mean, I think right now it's probably too late for most everyone in terms of, buying oil stocks. And if you do buy, I think you're probably just gonna hurt yourself in the long run because you probably bought at the heights of it when literally everyone is aware of what's going on. So I think it's probably best to just stay away really and don't FOMO because everyone is making a lot of money on it.
Yeah, I think the FOMO thing is an important thing to bring up because just because you see like Shell, BP, Exxon, Chevron, all of these companies just going up and up because the oil price is going up, it doesn't. You just need to take a step back and think about it and be like, right, okay, when everyone's going towards it, that's probably the worst time to go and buy something. So, yeah, just a thought I had about oil stocks, which I think is fair enough. You can say the same about a few different industries, but just at this very moment right now, oil's in the news everywhere, very popular. There might be half decent businesses, but if the oil price goes down, then what's probably going to happen is with the shares, it's going to go down. So, yeah, just be careful. So,
Yeah, and usually when it drops hard. Like, so yeah, it goes up slowly, but then it falls hard.
yeah, just a word of warning, just be careful. Just be careful.
Mm.
Yeah.
Anything else about oil?
I'm quite happy with my Equinor position. I'm not gonna lie.
Yeah, I think you're doing really good on that, aren't you?
I'm doing okay on that. I bought it. I can't even remember, but yeah, I'm doing okay on it. But I've got my allocation. I'm happy with it. I'm not planning to buy any more. I'm not planning to sell. I think it's one of the high quality oil businesses. Don't know if I've mentioned it before. I might need to do a video speaking about it. But yeah, quite happy with that. Yeah, that's about it really with oil.
You
Is
plan
that
on keeping it? Do you plan on keeping it?
I plan for the long term? Yeah. Oil production. I know you're not keen on oil and commodities, but oil production generally is a bad business.
Hmm.
Not the best margins usually. Quite a lot of debt. Just not the best place to be. But
Yeah.
Equinor is a little bit of an anomaly in some ways for a few
Mm.
different reasons. But a lot of it is to do with they can produce oil cheaper than most of the oil companies, and they have a monopoly in Norway with the oil because the Norwegian state owns most of the company. But because Norway is such like a liberal country, it doesn't actually matter. That's actually quite a good thing for that stock. But yeah, I won't get into it too much. But yeah, that's one of the reasons. Anyway,
how did you find that? Is it equinor, whatever it's called? How did you find that company?
That is a really good question. Quite famous value investor. I don't know if you've heard of Vitaly Katzenelson.
All right.
I don't know if you've heard of him before.
I've not heard of him. No.
He's a contrarian deep value investor. He's Russian, but he's based in the US. He's got a really good podcast, and he's written a few value investing books. The little book on sideways markets is one of them, and he's got a few other ones as well. But he's one of my favorites. He does a really good podcast. Doesn't just talk about investing, talks about life and stuff. But he's very good. I'd recommend him to anybody. 100%. So yeah, that's where I got that idea from.
Okay. Anything else about oil?
No, I think that's about it. I think we've covered everything, to be honest.
Someone asked a question, thoughts on Nvidia.
Yeah. Do you want to go first on that one?
Yeah, let's talk about Nvidia quickly. Nvidia, what can I say? It's pretty overpriced right now, Nvidia. So for me, it's an avoid, because if I buy it right now, I'm going to lose a lot of money because there's far more downside risk than what it can produce on the upside. And I know a lot of people are excited about Nvidia because of Bitcoin and all that stuff to do with it, and the chips shortage and all that. But you have to think about the price and the value, and right now the price is way above the value. So yeah, just avoid it. And I know a lot of people find it hard because Nvidia is flashy, everyone's investing in it, but yeah, just be cautious and be patient and wait for the right price. Me personally, I want to own it at $50. So yeah, I'm waiting. What are your thoughts, Lewis, on Nvidia?
Yeah, very similar. I just look at it and I think it's just one of the classic overvalued stocks of this market. There's no doubt over the past however many years it's become a bigger and better business, but the valuation is just not there. It's just far too high. I think I haven't done an analysis on it myself, but I've seen videos of it, and it looks like it's overvalued by at least 5 times, if not more. Depending on your return rate, of course, and stuff. But yeah, it looks like a good quality business.
Yeah, I've done a thing big on. Yeah.
Now I was going to say, what's like the share dilution on it as well? Because if it's overpriced, I'm guessing they'll be issuing that debt. So
yeah.
What
there's a fair bit. There's a few share dilution going on. I mean, they need to issue a bit of shares, to fund for the operations instead of taking on debt. So,
but isn't the business now profitable?
Yeah, it's profitable. Yeah, I'm not sure if they've issued share in like the last 2 or 3 years, but the shares outstanding is up within the last 5.
Yeah, that makes sense. I'll have a look after. Yeah, I'll have to have a look after. But yeah, if it's overvalued, just want to avoid. If you like the business, put it on a watch list. Happy days. But yeah, valuation is the most important thing. End of the day. So
yeah, I tried justifying Nvidia, but no matter which growth rate I put, it still doesn't even like move the needle. So
yeah, is it just like obscene growth rates, like 50% a year? And it just doesn't
I tried 50% growth rate with like 20p or something. It's still not a buy. So yeah, be cautious with Nvidia. I prefer Intel. It doesn't mean Intel is the better business, but it's better in terms of the value you get in. So yeah, that's just.
Yeah, it seems like Nvidia is a bit like Intel. So Intel in 2000 is a bit like Nvidia now.
Yeah.
Because I personally think this is for tech boom 2.0. I don't know if you have the same opinion, but I think the bubble we're in now with some stocks. Oh well, I know a lot of tech stocks, but a lot of stocks in the past year have gone down a lot, which could be the start of something. Who knows? But I think Nvidia is a lot like the Intel of 2000. Intel in 2000 and Cisco in 2000, they were the darling tech companies.
Yeah.
and they were going to grow forever, be the biggest business in the world. A little bit like Nvidia's become, you know, that narrative behind it. It's unstoppable. But it doesn't mean it's the case, does it? So, yeah.
Yeah, you just gotta protect yourself, really, and yeah, just be cautious. Don't do something dumb. Because I remember I've made 2 posts on Nvidia, and I think the stock's probably fallen by 50% on both occasions. By the time, like, I posted it once and it's probably dropped 50%. Then I posted it another one and it's probably dropped quite a bit. So I'm probably going to do a third post and say like, yeah, this is overpriced. Like, just be patient.
Yeah, valuation matters at the end of the day. So
yeah, that's enough about Nvidia, really.
Yeah.
Okay, we can talk about, when do you sell a stock? So you have a stock in your portfolio, it's growing a lot, a bit like Warren Buffett and Apple and Coca-Cola over the years. So when do you sell it?
Yeah, this is such a difficult question, because at the end of the day, when someone buys a stock, the only reason they're buying a stock is to make money. Like, you're buying a stock because you think it's going to go up over time, however long that is, how long your time horizon is, you think it's going to go up. When it comes to selling a stock, let's say you've made a lot of money on a stock, there's no right or wrong answer, but I think you've just got to look at what the big famous investors do. So, like, let's talk about Warren Buffett, for example, probably the best ever investor. Yeah, we'll talk about Coca-Cola first, because I think Coca-Cola is a good place to start, and it explains a lot about Warren Buffett. Warren Buffett allocates capital in the best way he sees fit at that current point of time, and he doesn't buy, sell, chop and change for the sake of it. He's very, what's the best rate of return I can get right now? And he will happily put all of his chips onto the table, and he's shown throughout his life that he's done that. First time he did it with Geico, American Express, he did it with as well. Coca-Cola in the 80s. So we'll talk about Coca-Cola. He bought Coca-Cola a really quite cheap valuation in the 80s. And I think something now, for dividends he gets, it's like 100% of his cost basis per share. So I don't know what his cost basis per share of Coke was, but it might be something like $2. Every year he gets his dividends from Coca-Cola. It works out being like over $2 per share. You have to look that up, but I've read that before. So if that makes sense. That's how much he's up on Coca-Cola. So Coca-Cola's at like $50, $60. He'll get $2, $3 per share. So every single year. Yeah, that just boggles my head a bit. But the main reason he's to sell is capital gains tax. Simple as that. So he's up so much on Coca-Cola that it wouldn't make sense for him to sell the stock, realize the capital gain, and then redeploy that capital into another opportunity. Because the tax is so much, I don't know what the corporate rate. I do know it's a lot though, isn't it? It's a big tax bill, and you got to take that into account when redeploying the capital. So it's just not worth it. So he'd rather just take his billions in each year as dividends, hold a company. He's owned it a long time. Yeah. So that's a really. What do you think on that, Wes? Because that's the reason why he doesn't sell Coca-Cola, and I obviously think it's a good business as well. So.
Yeah, I mean, that seems like a logical reason why he's not selling it. Also, another reason could be, like, because his gains is so much, it's impossible for him to sell, because if he sells, he's gonna cause huge pressure on the market, like on Coca-Cola. So by the time he's finished selling, Coca-Cola will be worth like less. It's not gonna obviously be worth $2, but you know, it's not gonna be a lot, but
Yeah, when he sells, it would have to be sold in a methodical way to not impact the market, and that could take years. That could literally take years and years to do, because if they impacted the volume so much on a day-to-day, like you say, it could cause the stock to go down a lot. So, yeah, that's another reason. But it's a capital gains, 100%. Got so much tax, deferred tax, that it just doesn't make any sense for Berkshire to sell Coca-Cola, taking the dividend, using dividends to buy other opportunities, such as when Berkshire bought Apple in 2016. So what happened with Apple was in 2008, 2009, Berkshire bought BNSF, the railway, the railroad as they call it. So they bought this railroad. This railroad produced a lot of cash, a lot of dividends very quickly. And from the period when they bought it until about Apple, they essentially used the money from the railroad and other cash, of course, and bought the stake in Apple. So they used that capital to buy Apple at a P ratio of about 10 at the time. And today, for up like 5x on that investment. So technically, Warren Buffett is the best tech investor ever. That's going to true it for people, but it's true. He's made hundreds of billions on Apple, the best tech investor ever, and it now makes up half of their stock portfolio. So give credit to big up Warren Buffett.
Yeah, and the thing is, when he bought Coca-Cola, Apple was in 2016, and then they just missed revenue, and a lot of people was freaking out like Apple is dead, like this is it, growth is gonna slow down, and a lot of people call him stupid for buying Apple shares, and look at him now, like he's done really well with that investment, probably his second best investment ever, behind Coca-Cola maybe.
I think it's his best monetary wise.
Yeah.
So if you do it on dollar terms, it's his absolute best investment. So I feel that says everything. The most money he's made is from Apple stock. So
oh really? Okay.
Incredible, really. Yeah. So, but yeah, that's one reason Warren Buffett doesn't sell as well is because he likes to own businesses forever. His favorite holding period is forever. When to sell a stock, there's a few different ways to go about it. If the stock gets your intrinsic value or overvalued way above it, then maybe it's a time to sell. If valuations get a bit frothy, let's say Apple gets a P of 40, might be a bit of a stretch for Apple. But if it was only a little bit overvalued, then it wouldn't be worth selling.
Yeah, I completely agree with you. I mean, for me, right, like the only reason I think someone should sell a stock is if it gets into bubbly territory, like we're talking a 40-50 period. Say like we own Apple right now, and it gets to like a 40-50p ratio. I think that might be a time to like, take the profit and run. Or if you see a better opportunity where you need money, you can put the investment from Apple into something else, and you can do that. That's another time you can sell a stock if you find better opportunities.
If the fundamentals of the business decline and you don't think the business is as good as it was for various reasons, then that's also another reason to sell. But what I would say on that one is you need to learn lessons from that when you're buying again. So let's just say if you had some bad earnings come out, I don't think that's a good enough reason just to sell everything. I think you've got to be a bit more disciplined with it. I don't know what you think on that. And I also think when you're selling to find a better opportunity, you've also got to be careful because is it really that much better? Are you just chasing the money? Are you just chasing the returns, getting greedy? Because that's some people do that. They're like, oh, I'm going to put money on this. This is much better. But yeah, I don't know. That's just kind of my view on it.
Yeah, and what was I going to say? I've lost my. I've completely gone blank now. What I was going to say, but
no, it's okay. Yeah, I was gonna. Yeah. I'll take this. Yeah. So let's say you get your process. You want to invest in individual stocks. That's your plan. Great, fine and dandy. Let's say you want to own 20, 30 stocks. Could be less, could be more, whatever. You pick what you want to own. And then when you go ahead and buy, you've got your criteria, you buy at a fair price. If you then decide to sell for whatever reason, when you've got that process, I think selling once you've got that process, I don't know what I'm trying to say. I'm trying to say, like, once you've got that process in place, in my opinion, if you want a stock, I think you should be owning it forever, unless you went into that stock thinking, let's say with Footlocker, If you buy Footlocker, we'll talk about it in a bit. Footlocker, we think it's undervalued right now. If it gets to its fair value, then sell. If that's what your plan was, go for it. Just stick to whatever your plan was. If you're buying and holding it for the long term, yeah, holding period should be infinite. But yeah, it's a hard one because there's no right or wrong answer to it. We all have different reasons. You might need to sell because you need to pay some tax. You might need to sell because you need some money for your house, a boiler, a house deposit. But yeah, we all have our different views on it as well.
Yeah, definitely. And until we're in that situation, which, well, I'm certainly not in that situation where I need to decide, should I sell, should I just hold on? No, I'm not in that situation. But when I'm in that situation, it's going to be definitely a tough one because I have to weigh a lot of things. But ideally, I would want to own a company for a really long time, like 5, 10, 15, 20 years. So yeah.
Yeah, I totally agree, and that's the way I go about it as well. I don't wake up in the morning, look at my portfolio, and think, "Oh, what am I going to sell today?" I've got the process of where's my cash, what's the best opportunity, what's the most undervalued right now. Because I'm looking at Alibaba and Facebook right now and just like rubbing my hands together. I want more cash. I want more to invest. My Smith and Wesson holding went down. It was 20% last week because had some bad news came out about a settlement or something, and the stock went down. So 20% from where I bought it, and I was like, oh, I want more money to put in. So yeah, I've trained my mindset to be happy when stocks go down now, and that's taken a lot of doing. But I'm actually happy when they go down because I can buy at a better price.
Yeah, and you can improve your margin of safety as well. But yeah, that will, us talking about the stock going down, that's another topic that I'll get into. So, a lot of people, they'll like a stock, right? It's gone up, and then one quarter they'll probably have bad earnings or something, or bad news come out, and then the stock will fall like 50, 60%, and everyone suddenly starts getting scared for some reason. And like, if you like it at a certain price, you should like it when it's on an actual sale. So invest. A lot of people say, no, I'm not going to buy because, like Facebook, for example, right? They had one bad quarter. A lot of people are basing their investment decision on that one quarter, when I think that's dangerous. Like, you should base it on like maybe a 1 year period, 2 year period, not like just one quarter. That one quarter could be an anomaly. So I think a lot of people should just look at the situation and think, is this an overreaction, or is this actually justified? And most of the time it's an overreaction, and I think you should take the opportunity to buy a company on each sell. Like Facebook right now is trading at a 13 PE. Like, come on, you're telling me Facebook is a below average company, a company with zero debt, that prints money like nothing, and it's just got the perfect balance sheet like you could think of. So 13p is just ridiculous for Facebook, and I know a lot of people are actually scared that they're not going to buy because apparently it's dead, even though Facebook has like the first most downloaded app in the App Store, and revenue is increasing. So you just gotta stop judging everything on one quarter and think long term.
Yeah, I totally agree, mate. And I absolutely despise quarterly earnings. I really don't like it. Quarterly earnings is a thing. So in the UK, it's quite rare, quarterly earnings. Yeah, sure, if I do have them, but it's usually bi-annually or annually. Quarterly earnings is such a Wall Street gimmick thing that the funds, the not hedge funds necessarily, but the suits, if you want to call them that, big people who work there, use it as a thing to really start promoting the stocks. Because if it's in the news more, if it's on Bloomberg, if it's on CNBC more, the clients are going to see it more. They're like, all right, what's this hot stock? What we're going to go into now? It just drives up the attention. Whereas me, I don't care about quarter. I do not quite care about quarterly earnings at all. I might get a little notification that comes up because on Yahoo, if you've got Yahoo Finance, for example, if you've got your portfolio on there, just a little watch list, it'll just show up saying so and so did so and so per share. I also don't care about earnings per share as well. I don't care about that. I hate earnings per share. I hate quarterly earnings. I love annual earnings. Don't get me wrong. If it's the year end, happy days. I'm all over it. But it's not going to add any value to my investment thesis by looking at quarterly earnings. There's nothing. Annual, yes, fantastic. I review my stocks once a year, based on the yearly earnings, and I've got notifications from my calendar for that. But quarterly, not interested. Just doesn't add any value at all. It's too short term. In a 3-month period, what is the business going to do to make me interested? It's not going to do anything, is it?
It's ridiculous. Like, come on, like, yeah,
short term thinking.
Yeah, exactly. Like, don't base your investment decision on a 3-month period. Like, people are actually saying, "Look, I'm not going to buy any more Facebook because it had one bad quarter earning." Like, no, you have to think a year, 1 year out, 2 year out, and yeah, not like one quarter.
And it wasn't even bad as well. It was bad because analysts said it was bad, and analysts, most of them are stupid.
Exactly. Like,
they said, "Oh, it was bad." The only thing which was
if you,
horribly bad was the user numbers didn't grow. But the revenue and profit did.
Yeah, I mean, with the user growth, think about it. We've been stuck in those for 2 years. Like, Facebook grew massively within those 2 years. So obviously, when things are opening back out, everyone's socializing more. People can travel to different countries. Like, no one's going to be using that. Not that many people be using like social media to get in contact with family. So it's obviously going to have a slight drop, and then it's going to level out to what it actually should be. So yeah, think about that. Like, people were using the social media for 2 years, and it's not sustainable.
3 billion people use Facebook's products, be it WhatsApp, Instagram, Facebook. And in terms of, well, China's banned them. So how many people in China? 1.5 billion. So half of the world's population which can use Facebook's products are using them. If you think about that, that is mind blowing. So you've got to think about half the world's already using the products. So to me, it's not a big deal that there's going to be a big slowdown in user numbers. It's inevitable. It happens to all businesses. If you look at the iPhone numbers are slowing, aren't they? So yeah,
I think
and it's all about narrative. Facebook is a great stock to hate. The media love to hate Zuckerberg. It's happened in 2018, Cambridge Analytica. It's happened with Zuckerberg in Congress, whenever he's been in there. Libra, they love to hate him. They love to hate Facebook. It happened with Microsoft in the 90s as well. Microsoft was nearly broken up due to antitrust.
Exactly.
Bill Gates was put under in the Senate, trying to break it up for antitrust. It happens all the time. So yeah, we're just happy to buy stock at better prices. So
exactly, and with Google, they're going issues with like European lawmakers. Like, they want to like put Google in their place, and I guarantee you, if Google have one revenue miss, you're going to be seeing articles about Google being investigated, and you're going to see all these negative articles like to justify the stocks going down, when you just got to think clearly. Like, this is a fantastic company. Like, it's people are just acting irrational. Yeah, so yeah, and it's the same with Alibaba as well. Like, everyone's talking about delisting. They're talking about everything, but when it was going up to 300, there was not one word of delisting or the CCP. So even though those issue was there to begin with.
Literally, yeah. It's all about narrative, and you just got to ignore the noise. Ignoring the noise is the biggest thing. Who cares what analyst says? Who cares what quarterly earnings say? Look at annual earnings. Look at a 10-year period. I love looking at a 10-year period for my stocks. 10 years back, what's happened? Yeah, quarterly just means nothing. It's just gimmicks. and it's just driving up attention, and just you don't need it. You don't need it as well. Who has the time every quarter to look at earnings as well? Who has the time to look at all the stocks' earnings? Who can be bothered to do that?
Yeah. Whenever I get the notification, I'll take a look, but I don't base any investment decision on just one quarter. You have to think long term. So
taking a look's fair enough because it comes up on your phone. But like doing deep analysis on each quarter doesn't mean anything at all.
The only time you should like quarterly earnings is usually as an opportunity to buy stocks, because a lot of companies tend to, miss on quarterly earnings. So use that time to, buy some stocks when they tank, because people
100%.
like to think short term and act irrational. And that's it. Yeah, I think that's about it really. Someone asked about how is a stock portfolio doing earlier on.
So in terms of my portfolio, well, I don't necessarily just look at my stocks individually. I've got my value investing stocks. I've got an emerging markets ETF. I've got money in crowdfunding investments. I call it my venture capital section, which has actually done the best out of all of them. And then I've got an inflation part, which includes commodities, gold, and then you're gonna hear me, Wes, a very small amount of Bitcoin. Which I bet you're surprised about. I own Bitcoin.
I'm actually surprised. Like when I was watching your video, I was like, "Is that actually Bitcoin that I see on the spreadsheet?" But
yeah, I've got my reasons for that. I won't bring it up on this value investing live, but yeah, I've got my reasons for owning it. But actually, my commodities and gold are doing very well. My commodities ETF is up like 35%.
Oh, that's nice, nice.
So yeah, I'm just holding it. I've got this little sliver as my inflation. You can think of the Bitcoin as well, but yeah, I'm holding that as my inflation because I think inflation could be here for a while. So I'm holding all that as inflation. My crowdfunding section is interesting because actually on shares in free trade.
Yeah. Oh, really?
So the investing app. I've developed a strategy myself to invest a portion of my portfolio into these crowdfunding companies. So I think I'm able to identify opportunities because all of these companies are private. They're not listed in the stock market or anything. It's all like private companies. They raise capital on sites such as Crowdcube and Seeders, if you've heard of them. They raise equity doing that. So when was it? 2019. Yeah, it was 2019. I bought my shares in free trade, I think it was. So yeah, they've done pretty well. They've got bigger and bigger, valuations got bigger, so that's going to look good for me hopefully in the future. So I've got my own process of that as well, of identifying what's good and what's a lot of rubbish. So but yeah, that's definitely the most risky element of the portfolio. And that's one reason I'm so really what's the word? Particular with the stocks I own. Because I've got that risk element of this venture capital equity crowdfunding section, which it's really, really, it's a lot more risky than for stock market, but I'm okay with that.
Yeah. So in terms of me, I don't know what my portfolio. I mean, it's nothing special really. I mean, it's doing okay. I'm beating the market so far this year now, because I was, just checking what my returns are to add to my spreadsheet and to keep track of my returns. So far this year, I'm beating the market, but it's too early to tell. I mean, I'm 7 months into this strict value investing, so yeah, I think judge me on like 3, 5, 10, whatever years, not like 7 months, but
yeah, I'd
it's
say
going good.
judge on 10, 5 to 10 years, 100%. Like that's the way to do it. A 1 year, 2 year period, a lot can happen. Since the bottom in March 2020, most people have made money. So yeah, just go with it. stick to your principles. Yeah, you'll be absolutely fine, mate, with what you're doing. Wanting 15% returns, you're going to be the next Warren Buffett, Charlie Munger.
So I mean, I'm just investing in companies, simple companies that I could understand, really, not these complicated companies. Like I do like like your Facebook. It's easy to understand. I mean, we're using one of their platforms right now. A lot of people tend to go into sectors that obviously looks complicated, like for someone like an average person like us. So I just like to keep it simple and hopefully generate some decent return. And that's about it really. And in terms of like my best performing stock right now, Sprouts Farmers Market, that's a Phil Town stock. Yeah.
Oh yeah.
I mean, he
yeah.
cloned me obviously because I bought it before him. But yeah, that's
I
I've
like
doubled
him. I
my
like his
money in
book.
that. Yeah, I've doubled my money in that with Sprouts Farmers Market already.
Oh
But
wow. It had a P
yeah,
ratio of 6 at one point, didn't it? It was
it's at
really low.
yeah, it's at like 15 now, 15 forward PE. But
Wow,
again, it's
that's
too
awesome.
early to tell because the stock can easily turn back down to $20. So
Very
yeah,
true. Very true. But
so
no,
I'm
that's
just
decent.
I'm not celebrating yet. See what happens in that 3-5 years time with that stock.
Well, I've got
But
something similar with Lockheed Martin. I
Mm.
don't know if you've seen them. They've all-time highs.
Well, I'm
They've just
so annoyed. I wanted to own that stock, but the stock never came down. It's just now it's gone all the way up, and it's like,
it got to 330, and
mm,
330 was enough for a 10% return for me. As a P ratio of, it was low. It got to about 10,
mm,
11, 10, 11, 12, something like that. I swear it was something like that anyway.
mm,
I think it was. It was quite low, and I was happy with that. But yeah, since then, they had good earnings. There's been a war going on. It's the perfect time for traders for Lockheed Martin, and it's gone really high now. I want to buy more of it, but I'm not buying unless it's below 330. So I'm just going to wait for the hype to go. It'll eventually.
yeah,
Weird things happen. So yeah, just be patient, and it might get there. It's like Huntington
mm,
Ingalls as well. A stock we both like the look of. That one's gone crazy as well.
yeah. I like it
All
didn't
defense
come
companies
down.
have.
Yeah,
BAE Systems, that's gone mega as well. Literally anything to do with defense because there's a war going on. Seriously, the narrative of these companies are going to get better contracts because of the war. Honestly, it all feeds into the stock price and stuff. So
exactly.
yeah,
Do you think I think it's actually a good time to unhook and sell, like sell it to the people who just want to buy it high, like, and then because I think
potentially, yeah.
the thing it will come back down when everyone stops buying because of the war going on. So
Yeah, I think if there was an
something to think
ETF which
about.
tracked defense companies, if it
Mm,
got to a certain valuation, then I'd think, could be a good short, but I don't really know how to
yeah,
short stock. So yeah,
yeah. Mm. But that's nothing. In terms of portfolio, I'm not looking to add too much yet. I mean, I'm just gonna be adding to what I hold currently. And this brings to me about this topic. What do you think about going all in on a specific company? Because I'm thinking, right, if Alibaba gets to $50 and Facebook gets to like 150, don't you think it's a logical thing to do? Like, I'm not saying make it like 99% of your portfolio, but put a nice, maybe 20%, 30% allocation, because obviously that there's valuations. Like, if you think of poker, right, what's the best hand? I don't know if you know the rules of poker. Like,
yeah, I don't know the hands, but
it,
I get the
yeah, so
all-in aspect of put all your chips on the
yeah,
table if you think you got the best hands.
like
Royal
nine
flush or
times out
something
of
like that.
ten, yeah, nine times out of ten, you're gonna win. So that's how I see it. Like Alibaba at $50, like that's not out of the realms. Like it's
Not at
literally
all.
trading below. Yeah, so I'm thinking if it does get to that, it might be a logical thing to do. Like, and even if it doesn't work out, yeah, we're both young. We can, yeah. You
Yeah, for me, I've had a real think about this before, and
know,
personally, I don't think I'd be able to sleep at night if I own two stocks. I wouldn't be able to sleep
not
at
two
night.
stocks. I'm saying allocate a large position to the. Obviously, you have all the other stocks, but make it a large portion, like concentrate it.
You see, I want to own 25. So for me, I always say, like, let's say if you want to own 10 stocks, you want to own 10 companies in your portfolio, that's it. Each position's 10%. And let's say, for example, 2 months ago you owned Gazprom. That was one of your holdings. 2 months later, all of this stuff happens with Russia, Ukraine invasion. Gazprom shares fall 92%. And you've lost 9.2% of your portfolio. Let's round it up to 10%. You've nearly lost all your capital. Fraud can happen in companies. Enron 20 years ago happened, very big company. Happens with some other companies. It doesn't happen all the time, but it's not just about companies going bust, bankrupt, looking coffee, whatever. Companies can underperform as well. So Alibaba or Facebook might not do better, might not do well. It's unlikely because of the track record and stuff, but there's always that chance. Sure, if you get it right, your returns are going to be much better and you're going to get somebody laughing, probably get 20-25% returns. You'll get 20% returns if it's at 50, surely. Or something like that. But it depends on your risk tolerance as well, because say like Charlie Munger, the Daily Journal, what do they own? Or what does he own personally? What is it? The Daily Journal, Berkshire, Costco, and some rental apartments in California. That's what he owns. He owns about 4 or 5 different assets. And for him, that's cool. He says that diversification. He's a very smart man, and I can't knock him. But I don't think I'd be able to sleep at night if I just had 2 stocks.
I mean,
I also think there's too many stocks though as well. I personally, if you own 50, how do you do it? Yeah.
Can you beat the market with 50 stocks? I don't know. If the top 3 are concentrated, maybe top 3, top 4.
Peter Lynch did it. He owned thousands of stocks and beat the market, but he was he did the A to Z thing. I think he did anyway. He wasn't investing in like the blue chips, let's just say that, because you generally don't beat the market by looking at you can beat the market with blue chips, but you know what I'm saying. So I don't think I'll ever go all in on a stock. I'll be very, very convinced it's going to do well. So, like for example, I've actually bought more Alibaba and Facebook than I probably should have done, but I bought twice my allocation. So instead of 2%, then I'll make it like 4% on portfolio or something, 4% each. I'm happy with that because if they grow like I think they do, they will end up becoming a large part. And I won't sell them. I won't sell them once we get there, because Alibaba, we think it could be $1,000 stock in 10 years' time, very easily. So I'll be happy with that. But it takes some guts, doesn't it, to own 2?
I mean, even if you do go all in on those 2 companies, like you're gonna own them at a very low average, so they could grow at 0% and you can still generate 15% return, 10% return. So because of that margin of safety. And for me right now, my Alibaba allocation, it's always been 20%, and then Facebook's like 17. It's always been fluctuating between 15 and 17. And then Tencent, it was 15, now it's 13 because it's gone down a bit, but I need to top up on that. So like my top 3 holding are like 40% of my portfolio. And
well, if your thesis plays out, you're likely will outperform the market, but you've got to be able to stomach that at night. And if you can, then happy days.
I sleep like a baby. Like, I sleep like a baby. Like, I don't really. And the thing is, my portfolio isn't that volatile. Like, it's not. It's not. For some reason, it's not. I think it's because I have a few decent winners. Like soaking up those gains that the top 3 are losing. But I mean, I like to put large allocation to my best ideas, and so far, Facebook, Alibaba, and Tencent are my best ideas.
Yeah, no, that's interesting because the way I see it is we're two value investors. All right, I own Bitcoin. I am a value investor, I promise. What was I going to say? We have different approaches. So I personally want to own 25 great quality companies at a fair price. I'm happy with a 10% plus return. You're happy with a 15% plus return. But I think why you want to own less stocks, I think not something I've worked out. 15% returns are very hard to come by. So you're naturally going to own less companies. So you're likely going to outperform the market and myself with, say, maybe 10 stocks or maybe even 8 stocks over the long term. But if you can sleep at night and you can stomach it and you keep your process, go for it. All credit to you.
Yeah, because right now, I'm not going to lie, my Facebook's down like 25% and my Alibaba is probably down like 30%, and I'm fine. I mean,
just keep get that cash in, and if you think it's undervalued still, you know what to do, don't you?
Yeah, I mean, I bought some Alibaba recently, and yeah, I'm gonna keep buying more. Like I get paid Friday, so I'm gonna buy some more Alibaba. Hopefully, get that averaged around 140 because I'm at 168 right now. But if I get at 140, that's pretty solid for the long run. And my goal with Facebook's to get it to like 150, 140, but that's a long way away right now. But yeah, we'll see.
It's interesting though, different approaches, but we have very similar thoughts on like value investing, but we have a different approach to it, which interesting, isn't it? We have the same principles in terms of we want to buy at a low/fair price, high quality, but the slight differences. But all investors do, which is, I think, it's a good thing. It's just who we are, isn't it? We're not all going to be robots. We all have to own 20 stocks. We all have to have a diverse portfolio. We all do it different. So like I hate retail. I hate car companies. I hate retail. I hate telecom companies. I hate utilities. But yeah.
Like me, I don't mind retail. Car companies, I've never invested in. I don't think I probably will. I mean, I own a company that sells cars, but that's not exactly the same. Like,
don't buy car companies for shocking. The balance sheets are horrible. Too much. Don't make much money.
What about airplane?
It's horrible. Airplane.
That's worse, isn't it?
They are worse. Yeah.
They go on there every 5 minutes, don't they? So
yeah. I don't like banks and insurance only because I don't understand them. I don't understand the risks. I know how to value them. Price and net tangible book value. If you can buy a bank for it below its book value, then
1.0
below 1.0 onto a winner. But there's risks in them which you don't see on the numbers. And you got to be very clever to understand it. So I just avoid personally.
Yeah, that's me, right? I found a really good insurance company. It's trading at 0.5 price to book ratio, and nearly zero depth. And I'm thinking, I wish I like knew. I know how to value insurance, but I don't get like how the business works. So yeah, I wish I'd know how insurance works because I would have bought that and made it a good part of my portfolio. But yeah, it's been performing actually well, and I've just been looking at it. It's not, I haven't bought it, but it's up like 12-15% up this year. So yeah, it's from the Bahamas as well, the company.
Oh, okay.
Yeah,
interesting.
Bahamas, I think Bermuda, Bahamas, one of those two countries.
It'll be Bermuda because they've got a big insurance industry there because of the laws.
Yeah, it's that. Yeah. So yeah, if I understood it, I would have literally invested in that straight away. But I don't, and I don't want it in my portfolio. If it goes down, I don't understand why I should be buying more.
Yeah,
so
that's the worst thing in the world, isn't it?
Yeah, but Yeah. What apps platform do you use? Do you mean investing apps or what? Um, yeah. Yeah, in terms of value investors, like we all have the same principles, but we all, most of us have different ways of structuring our portfolio. Like Charlie Munger, he says there's not many great businesses, and he prefers to have like four stocks or whatever. And then you look at someone like Warren Buffett, he owns way more than four stocks, but he has them concentrated. So yeah, it's interesting to me, really. Some value investors believe diversification, some believe it's diversification. Charlie Mungers, he says, um, if you if you're incredibly diverse in terms of what you hold, then yeah, you don't know very much. But it's all about what you can handle, really. And there's no right or wrong approach to anything. It's just what you're comfortable with.
Yeah, as long as you understand a few key principles,
Mm,
valuation is number one.
mm,
You need to buy at a good price.
mm,
That's probably the most important. Don't
mm,
time the market in terms of buying, selling, getting
mm,
in and out of stocks.
mm,
You understand a few key principles like that, and then you
mm.
can have your own approach to it. So
Yeah. Um, I think that's about it. Then we haven't talked about Footlocker.
yeah, do you
Yeah.
want to lead on Footlocker?
Okay, so everyone knows Footlocker, huge brand presence. They sell like branded shoes, mostly Nike products, and I think around 70 or 80% of their products are from Nike. And recently, Nike came out and said they want to step away from that, the Footlocker, and Footlocker stock I think fell like 30%. And the thing is, with Nike, they want to go to more e-commerce, like online kind of thing. And yeah, the shareholders of Footlocker didn't react too well to that. And to be honest, I didn't think that would ever happen when Nike decided to cut back on the partnership with Footlocker, and crazy it did happen. So now we have to ask ourselves: is this a value play? Is this a value trap, or what? But it's a difficult one to tell, really, because Footlocker, they haven't been growing that much in the past, what, 5 years. So yeah, but they are trying. They've recently trying to shift away from like the mall presence and have their own like box like retail company. And I think for Footlocker, I think this is probably the time to have a restructure of the business. So maybe they can start by, probably halting the dividend because they do pay the dividend. Maybe halt that and have that free cash flow to maybe start, you know, innovating the company to more online, and maybe start shifting away from Nike, stop depending on Nike. I was thinking maybe they could start by selling sporting goods. I don't know if you know Dick's Sporting Goods. Do you know that?
Yeah, I've heard of them. Yeah,
Yeah. So Dick's Sporting Goods, they sell like sports wares and other like random stuff. So I'm thinking maybe Footlocker could go into that market, like sportswear, have like the branded shoes as well. And I think that's definitely a potential they could go into, and obviously try and get their presence online more because everything is going online right now, isn't it? Um, but yeah, I think it's going to be interesting to see what happens, really, because Footlocker definitely needs to stop depending on Nike and go down their own path. But yeah,
yeah, interesting.
mm. But in terms of like the financials, it's really good. The financials barely any debt. They do go aggressive on buying back shares, which is good to see. Um, yeah, it's basically good. So for me personally, I used to own Footlocker, then I sold it in favor of something else. But it's a difficult one to say if I'm going to enter again. I want to see if they've got, like Intel, they've got this like 3 to 5 year plan.
Yeah, yeah,
Um, if Footlocker came out and said we're gonna try and do this within 5 years, I would actually consider going back in Footlocker. because
Yeah.
the management is really good. They're good at allocating capital appropriately, and they're very honest. So I would actually trust them to execute that plan. But until then, for me, I think I'm just gonna wait on the sidelines just to see what happens in terms of the plan they're gonna go do in the future. Yeah.
Yeah, just have a look on Yahoo Finance at some of the numbers. I didn't know this, but they're selling for below book value.
Oh, really?
Yeah, so it says here that most recent quarter, let's have a look. Book value per share is $32.24. It's currently at $28.25. So it's trading below book value. You rarely see that with companies, especially that's a proper Ben Graham style of.
Yeah.
You know what? I think if Footlocker got to say half its book value or 60%, I would go for it.
What price would you say? That?
So what's that? 32. What's 32 divided by 2? 16. 16, 18 maybe. $18 a share.
You think the
You'd be
stock
buying
price
it.
can get there?
You'd be buying it for 60% of book value, and if it went back up to 32, you'd have quite a nice gain. So if it got to that, then yeah.
Yeah, I think the
Just
risk to reward ratio.
the
Yeah.
risk to reward, that would be one way I look at it. It wouldn't be something I want to want forever, but that risk and reward would be a cigar butt in my opinion.
Yeah.
I'm not saying it's going to die out, but in terms of a proper deep value investing player, then Footlocker is an interesting one. Yeah.
Yeah,
Interesting.
that's interesting. Yeah, I mean, I'll probably, if it does get to that price, I think, yeah, it's definitely something to consider. Maybe allocate a small position in your portfolio and see how it plays out. Maybe do a special situation, just maybe hold it for 1 to 3 years, see how things plays out really, and go from there.
Yeah, I agree with you about the plan. They need a plan
Yeah,
because the business has been stagnant for a long time. You can see from the sales. But if they've been buying back shares quite aggressively, then the business doesn't need to grow for you to see that return in hindsight. But yeah, it's a bit of a dinosaur company, so you would want to see something. Yeah, but it's good that they've got no debt. So it's hard for them to go bankrupt unless all the sales go. If all the sales went, obviously they go bankrupt, but they've got no creditors. Current ratio is 1.7. So they're not going to go bankrupt in the short term because they've got more current assets and liabilities. No long-term debt. They're still profitable, even though it is decreasing / not the best. Yeah, will be interesting. If they have a plan, then could be very interesting. I don't really go for retail, as you know. I'm not a fan.
Yeah.
I just see it as a bit of a race to the bottom. But if something's so cheap like that, where you buy it below book value, then Ben Graham will be up there saying, "Lewis, buy it, buy it."
Yeah, definitely.
But yeah, it's not something I'd usually go for anyway. It's not my kind of company.
Do you go for grocery stores?
Well, I've got Walgreens, so maybe, but that's more of a pharmacy. But I've looked at Walmart before, very overpriced. Looked at Kroger.
It's always been.
What's that? Sorry.
Walmart's always been overpriced for some reason. I don't know.
Yeah, it's a very weird one. I don't like the UK supermarkets at all.
I don't as well. I've stayed
Some of the
away from. They're
worst
so
stocks.
awful.
You know what I don't like about supermarkets? It's a race to the bottom. It's a race price wise. You are competing with you've got so many competitors. You've got Aldi and Lidl, privately owned. They're good businesses, run really well. but it's just a race to the bottom, and to grow shareholder equity, races to the bottom are never very good, in my view. Sprouts Farmers Market might be different because it might have a different clientele. It might be something completely different. I don't know. But in the UK, Morrison's, Tesco's, Asda, Sainsbury's, they're just battling all the time, and not one of them is going to come out on top. They're just going to keep squabbling forever. It's not like a business, let's say Louis Vuitton, like we like to talk about. They are number one for luxury goods. They own luxury goods. They have that pricing power. Rich people always want to have the Louis Vuitton shoes and bags and whatever. They don't have a race to the bottom. They set their prices and they keep them. Ferrari, another one. They sell how many cars for sale here? I can't remember what it is, but it's not many. But everyone, rich people love a good Ferrari, and I just prefer businesses like that, which have a brand, which have pricing power. I just don't think supermarkets quite have that, and that's why I personally avoid them. That's why I avoid retail in general. But that's just my view. That's just my view on it. But,
definitely. With Sprouts Farmers Market, it's most likely organic, like fruit and veg, like fresh vegetables, and so they've got like Kroger to battle with, really. And
so it's not just like a standard thing. They've got something a bit about them. It's like they've got that edge. It's not just Kroger, Walmart. I don't know American supermarkets well. I know Walmart is the biggest, but there's another one. I can't remember what the name is. I've seen them before. Sprouts Farmers Market, Kroger, Walmart. If they're here to stay, it's a decent business. It might be a bit different to the UK. UK, it's just a war of attrition. US, it might be a bit more relaxed. Might be easy to make a profit. So,
I think that's it in terms of like Footlocker. Let me see.
I can't believe it's below book value. I just can't believe it.
I did not realize it was.
Wow, that is incredible.
I might have to put an alert on that. $20, maybe $18.
$18 if you can buy it for 6 cents for $1. That's classic value investing play as well.
Yeah.
Even if it goes bust and bankrupt, you're getting some back.
Yeah, exactly.
Interesting. Like I didn't know it had no debt as well. Like I didn't know it didn't have much debt.
Yeah, no, they don't really. It's surprising, and also look at the ROIC. I think it's pretty high as well.
Yeah, that's interesting. Do any super investors own it?
I don't think so. No.
Okay.
I don't think so. I haven't really checked if any super investors own it, to be honest.
I'll have a look after this.
Yeah. Footlocker. You got anything you'd like to touch on?
No, I think we'll cover quite a bit, to be fair. Just managed to get Nvidia in there as well. Have a quick chat about our portfolio. Yeah, I think one thing I'd say about my portfolio is, in terms of half of my portfolio is value investing. Like I say, I've got the other part of it in terms of I've got an ETF for emerging markets. So my hope is to get my emerging markets allocation through this ETF, which I've spoken about before, EMQQ. Half of it's Chinese companies and half of them are very undervalued. So if you type in EMQQ index, there's a website about it. Half of it is Chinese, and you're talking Tencent, Alibaba, Process, JD, all of them. And then they've got other companies as well. Mercado Libre. Although that one, out of all of, say, maybe hypey ones, that is one which it could be the Amazon of South America. So it's not like I'm just buying the Tesla of South America. It's got a little bit of substance behind it, a little bit more than you'd think, and it's got some others as well. So, but
it's got stretched valuation though. It's got really stretched valuation.
Yeah, Mercado Libre, I think it makes up about 2% of the index, so I'm not too worried. But the
Yeah.
Chinese stocks make up 50%. So yeah. But if you owned any emerging markets ETF, you'd own a Mercado Libre. That's the thing, though. It's a bit like I'm holding that as kind of not an indexing strategy, but kind of. I just think emerging markets are going to outperform the normal index, so that's why I'm holding them.
Yeah.
But
Yeah. Yeah. Oh yeah. One thing about my portfolio, I added JD to my ISA now. So
oh, nice one.
yeah, the stock came back down to what I bought it for. So because I didn't want to sell it and then buy it up at a high price, I just wait for it to come back down. Then I sold it and I bought it at practically the same price that I originally bought it. So now it's in my ISA. And
Very
it's like
good. Very good.
7%. Yeah, it's like a 7% allocation. So not much really. So that's the only change I've done.
Yeah, sounds good. I actually bought a few Games Workshop on Alphabet, so I'm already down.
Yeah, I haven't checked Games Workshop price today because do you know it?
£66, I think.
I was 66. Ooh, I'm starting to think it might get to 45, but we'll see. But I think
Mate,
we'll
who
give it
knows?
a
It might
month.
do.
Yeah, we'll give it a month and see how well it performs in terms like because it could go down by a lot within that month. And if it does, I'll be a buyer of Games Workshop.
Yeah, I really like that company. Really, really
Yeah,
like it. I like it a
very
lot.
high quality.
That's the thing I like the most about it. It's the high quality side of it. Yeah, if you can buy it at a good price, then happy days.
Yeah, definitely. I think that's it really. Anyone got any questions they would like to ask us? Um, maybe we can just touch on, so with the market just going down all the time, like how are you handling it? Like a lot of people might be scared right now because stocks are only going down. So what are your 2 cents on how people should handle this market?
Yeah, I think it's important to know what you own and be very confident in what you own, because if you start questioning, oh, why do I own this? You really start to question it when it goes down 38%, like my emerging markets ETF is down 38%. So a little bit like your Alibaba, you're down like 30, aren't you, or something?
Yeah.
It is what it is.
Yeah,
You
like
know,
we can't time the bottom really, so
we can't time the bottom of it. We just we think something's a certain valuation, got good prospects over the long term. We're going to do well. You've got to train your mind that stocks going down is a good thing for you, because you can buy at lower prices. And then over the long term, over a decade period, yeah, you want them to go up. Sure, you do. So yeah, you got to train. It's not easy. You've got to train yourself. So
David, we like Alibaba and we both own Alibaba. That's about it, really. I mean,
yeah, we like it a
yeah,
lot.
yeah, and yeah, in terms of like buying stocks that go down, make sure it's a solid company with good fundamentals and plenty of cash flow. Make sure you bought it at a good price, and if you bought it at 50 and it goes to 30, you should be buying more because you have a better margin of safety and more upside. But if you own a lot of like speculative investments that have run up the market the past 2 years and they're getting crushed now because everyone's panicking, I think averaging down is probably very dangerous because you're buying
100%.
bubbly, really bubbly stocks and they're probably going to overvalued and you're just buying more expensive shares. So
Buy high
I think a
quality.
lot buy high quality at a good discount and you shouldn't really care if it goes 10, 20, 30% down, because in the long run, the market will realize, wait a minute, this is a high quality business. Why is it so low? And then people will bid it up. So
yeah, like I bought Alphabet and Games Workshop. I was honestly buzzing. I was so. I think they're such high quality businesses that over the long term, with reasonable growth rates, they're going to do absolutely sound. So
yeah,
I love businesses with no debt as well. Them too. Oh, it's fantastic. It's like again with Facebook, Meta, love it.
He recently just bought Baba and Meta. He's loving it, man. That's insane. That's like 20% return, you think? That's crazy. I mean, you basically get the reality labs for free, like if you bought Facebook at this price.
Yeah, that's what I think is fantastic with it. Is you're buying Facebook's business, which the reality labs is costing them 10 billion a year in free cash flow. If you add that onto the business, if reality labs closed its doors, you're going to add that 10 billion onto the free cash flow. So for Facebook's numbers now, what they report on their free cash flow, the reality labs actually makes the numbers look worse, even though, you know what I'm saying, Wes?
Yeah.
Oh, my light just fell away.
And I hope Zuckerberg's aggressively buying back shares at these prices.
Fingers crossed. I really hope he is.
Yeah.
They could buy back like 6% of the shares, couldn't they? With what cash I've got or something. So
yeah, that would really give value to shareholders, but please don't offer dividend. I don't want it. I want the share buyback because that's more efficient. I was going to get into the market in 2019 when the COVID decline hit, but I bought it. So when the decline came, I jumped in straight. Okay.
All right, decent. That's some decent returns then.
Yeah.
Yeah. It was like a 3-week period, the market just tanked. And then in another 3 weeks, it already went up half again. So
I don't understand.
The buying opportunity just went like for most stocks, which is
Did
good.
you buy
You can
anything?
see, did I buy anything?
You doing that?
Bitcoin.
Bitcoin. Oh, so that's when you bought Bitcoin.
But whereas I bought £100 worth of Bitcoin
Mhm.
in March 2020, and that's I haven't put any more money into Bitcoin. I bought £100 worth of Bitcoin. I said, if this goes to zero, I'll be able to sleep at night. But luckily for me, it's gone high. Way.
Yeah.
But I started buying in May 2020. British American Tobacco was one of the ones. One of the first ones on the list. Then in 2020, I got Rio Tinto. What else? But I bought Berkshire really cheap. Like really cheap. I think it was trading for 1.1 book value. And that's when Buffett starts aggressively buying back. He said before, we'll start buying back Berkshire shares when it gets to 1.1 of book value. And it got to a certain price, and I was like, right, this is ridiculous. So I just loaded up on Berkshire. It's one of the best performing stocks, actually. So, yeah.
Okay. Let's see. Any more questions? But I think the European market might be interesting. Apparently, it's in a bear market now. So.
Oh, really? Well,
Yeah,
that's what.
I saw it on one of the Instagram pages.
I can't wait to see all the bad news.
Yeah. I didn't know it was in the bear market, to be honest, until I saw that.
I didn't even know. It doesn't even bother me.
Yeah.
Bear market, bull market, whatever. Stock will hit my price. I'll be after it. So.
Exactly. I'm just happy at the opportunities I can get. Like, I don't tend to buy a lot of European stocks because I don't know what to buy. Like, most of them are already so expensive. So, but now
I've got
there's
a few on
few
the list.
decent ones. Oh, really? So Louis Vuitton's one. Which other ones?
Novo Nordisk,
Mm-hmm.
if you've heard of it.
Oh yeah,
They're,
yeah, I've heard
they're a
that. Yeah.
Danish pharmaceutical company.
Mm-hmm.
They mostly deal in insulin and anything to do with diabetes.
Yeah.
Yeah, diabetes is like one of the biggest illnesses in the world. It's only getting bigger.
Mm-hmm.
So I know it's a bit morbid, but
Mm-hmm.
they've got a competitive advantage there because they create all sorts of products. There's a few other ones as well which I'm interested in. A company called Kone. They make lifts.
Mm-hmm.
So
Lifts. Okay.
as in elevators, yeah. So in the world, there's 4 companies which dominate the elevator market, and you can just imagine it's
Mm-hmm.
quite a regulated industry because
Mm-hmm.
elevators, health and safety is like the most important thing. And there's like 4
Yeah.
companies that dominate it, so we've got a monopoly, all 4 of them. So Kone,
Mm.
Otis Worldwide, Krupp, and I think
Mm-hmm.
Siemens. So there's about
Oh yeah,
4 of
I've
them.
heard of that. Yeah.
So there's 4 of them which have dominated it, and
Mm.
the world's getting more urbanized. Basically means more skyscrapers, more lifts, more sales,
Mm-hmm.
and as well,
Yeah.
if they don't just make a sale, they have service contracts as well,
Mm-hmm.
where consistently upgrading and servicing lifts, and they're locked in for a long time. So yeah, lifts are expensive as well. You're talking
Yeah.
millions upon millions to buy an elevator. So there's only so many custom producers of the lift. So I think it's a fantastic business personally. And Kone, it's a
Mm.
Finnish company. It's one of the biggest Finnish companies. Bit overvalued at the minute, but it's a fantastic business in my view. Not much debt. So
Okay. Yeah.
I like
I
it.
mean, it's this simple business is really that you got to go after, and yeah, pretty
Yeah.
easy to understand.
I've got
For me,
Ferrari as well.
Ferrari. Okay.
Ferrari. I class it as a luxury good, so a bit similar to Louis Vuitton. I put it in the same boat. I got that idea from Guy Spear. He owns it.
Oh, yeah, he does. I think I saw it in his latest filings.
Very overvalued. It needs to drop
Yeah.
like 70%, but I'll buy it when it
Seven.
does. Yeah, it's got a
Mm,
PE ratio of like 40 or 50. It's ridiculous.
no, that's too much.
So I don't know why. He must have bought it really cheap.
Yeah.
He must have bought it when they were spin out of Fiat Chrysler,
Mm,
because Fiat Chrysler used to own them.
mm,
And it IPO'd. So I think they must have bought it sometime. But yeah, to me, it's overvalued right now. But what else do we own? Can't remember. Oh, not what I own. Oh, Universal Music Group.
Universal Music Group.
So Universal Music Group, it's listed in Holland
Mm,
because it was owned by a French company and it's recently just
mm,
listed last year. A very interesting company.
yeah.
They own a third of the world's music rights.
Mm,
So there's like 3 companies which dominate the music industry, and they own basically a third of music rights. So
mm,
monopoly essentially.
yeah.
No debt, growing a lot as well. So interesting. Needs to drop a bit again, but yeah.
Mm.
Yeah, I'm just letting
Just gotta be
you know
patient.
all my secrets, but
Yeah. Just gotta be patient, really, with that.
yeah, exactly.
Yeah. For me, European stocks. I'm looking at ASML, so microchip
Oh
semiconductor
yeah,
company.
I've heard about one.
Um, looking at Louis Vuitton. Um, looking at Adidas. Um,
Adidas or Nike? What's your preference? Clothing and stock.
ooh, ooh.
Look, I'm a look.
I'm not with
I'll
Puma,
keep
but
it.
I've got I've got all 3 clothing. So I've got Nike and I've got an Adidas jacket. I've got like Nike shirts and I've got a
Night
Puma hoodie.
box.
So
Look,
yeah.
it's a night
So
box there. Night
oh yeah.
box, night jumper. I'm
But
I'm biased, mate. I'm not gonna lie. I'm biased. I maybe
yeah,
should buy Nike stock.
yeah. I said in one of the voice things, I wouldn't mind. I would actually own both of them if they were both dirt cheap.
Okay,
Like, I mean,
that's fair.
value is
Go for
value
it.
at the end of the day. Like,
That's
so
true, mate. That's true.
yeah, but um, it looks like Adidas is the one that's going to reach a decent price first because Nike doesn't look like it's going down
Nike's trading
anytime
like
soon.
a tech stock. It's ridiculous.
Yeah, it's so
It?
crazy.
It's dropped to like 120. Still needs to drop in half.
Mm.
I
Yeah.
think it's a fantastic company, but
Mm.
Sven Carlin did a video on it, and type in Nike Sven Carlin. I'll have a watch of it after. It basically says fantastic business, compounded over the long term, but the valuation is just stupid. It basically just says that it's trading as if it's like an ultra growth stock. It's gonna grow earnings at 20-30% for the next 10 years. And it basically says that there will be a point when the market or analysts, whoever are saying it's worth this much, realize, oh, it's going to grow at 6% a year now. And it flips from being a growth stock, and it flips to be becoming just a normal company. And that is when the price will tank. Whether that's a crash or whether that's earnings, it will happen at some point, and that'll be a moment where it just that's the time
It's
to
gonna
buy.
go down
So
hard as well. Like,
it will. Valuation is so important. So love the company. I'll be buying it when it gets to my price, which is $60.
yeah,
So I'll wait for it.
yeah. A lot of people they'll have like Nike gears like yourself, and then they'll
Mate,
think,
I love it as well.
yeah,
Great
like you can
business,
like
great
you
balance
can like
sheet.
the products, but it doesn't mean you should go and buy the stock
Oh yeah,
because
I love the products. It makes me want to buy even more. So
yeah,
it's weird. Like I think, oh, I'll go buy Nike stock. I love the products, but it makes me want to buy even more at a lower price. It's like when it gets to that price, I'll be loading up on it, me.
yeah, it's the same with me and Adidas. Really, I mean, I don't mind Nike or Adidas, but yeah, like I have a few Adidas things, so yeah, if it does get to my buy price, I'll be loading up, have a decent
Nice one.
allocation to it. So yeah, just gotta wait and see really.
Very good.
Yeah,
I've only
I
got
think
one Japanese company. I've got Nintendo on my list as well.
uh,
Love
I'm
Nintendo.
so annoyed at that. Like I made a post about it, right? At 55, the stock was at 55. That was the buy price that I needed to get in, and I think the stock's like 63 now. So
Oh
I have to
wow.
wait again, wait for it to come back down because I didn't have the capital then to buy it, and it shot up straight away. So yeah, that's the one company I would like to have in my portfolio. I could have it in an ISA now, I think, which is good. So yeah, I'm just
That's good.
waiting
Yeah.
patiently again for that. I like the company, great mold. Like
Love it.
it's a cult following, isn't it? Like with
I call it
Mario and
the Disney of video games. That's what I call it. But
I agree with you in that.
we have no debt as well.
Zero, so that's
Japanese companies are
crazy.
really, really prudent. Since they had their big crash in the early 90s, corporate balance sheets have barely had any debt. So
Mm,
it's just such a plus. Like
mm,
I used to want to own Disney, but
yeah.
a few things put me off it. Quite a few things put me off it, but
Well, like what the huge debt?
huge debt load. The debt is a
Yeah.
big deal. Acquiring
Mm,
Fox, great, but is the amount of debt you're piling on your business worth what you're buying?
yeah.
I think COVID showed fragilities as well. Like I know a pandemic
Mm,
was unlucky, but if we had no revenue, well, not much profit for like 18 months, and you had to take on more debt, issue shares, and
mm.
yeah, I just don't like businesses with a lot of debt. It just puts me off massively, really.
Yeah. Yeah, that's enough for me to say no to companies. Like they might have perfect everything, but if they have huge debt level, then I might have
Me
to
too.
pass
It just puts me
because
off.
yeah, I want to own companies long term. I don't want to have to worry that they might go bankrupt the next day. So
Yeah,
yeah.
that's why stuff like AT&T, Volkswagen, anything like that just doesn't interest me at all. Large
Mm,
debt is just bad.
yeah, I agree. I agree completely. Um,
Yeah.
any questions?
Yeah, I'm gonna have to get going anyway.
Yeah. And we've actually gone quite long. We've got into a few topics. It was meant to be
We have,
not thoughts on where the VIX is at today. I actually haven't even looked at the VIX.
I've no opinion on the VIX.
Yeah, same.
For me, it's just a stupid thing. Don't make any sense. No one makes any money on the VIX, so why isn't it even a thing?
Mm-hmm.
Just
Well, what does it even do? Like the
it tracks
VIX?
volatility. That's it.
Oh, really?
That's all
Oh.
it does. And no one makes any money. If you buy a VIX index, no one makes money. Like, it's really expensive to own, lots of fees.
Mm-hmm.
The only time people made money was in March 2020, but you had to own it before all the stuff happened. Yeah, just stupid instrument.
Yeah, I don't
Sorry.
even pay attention to it. I
I'm getting a
mean,
bit
I
deep
see
on
the
that.
VIX. Yeah, I see the VIX when I log in on Yahoo Finance, like on the the top bar with all the indexes, but I don't really pay attention to it. So
It's another Wall Street thing. It's another Wall Street
yeah,
thing. Oh, the VIX is up really high today. The VIX is really high. You need to worry. You need to sell your stonks.
yeah. I mean, it's cause it's. I mean, if someone come into the market and they have some knowledge of what the VIX is, it's just gonna scare you, and it's a scare kind of thing.
Yeah,
So
that's what it is.
yeah,
So,
yeah. To be honest, I don't really pay
yeah,
attention to it. So.
I don't care.
Yeah, to me, volatility is good anyway. Like,
Yeah, just means I
yeah,
can buy more stocks cheap. So,
mm,
yeah, got to get going anyway.
yeah, yeah.
Got some stuff to
Done. We
do.
definitely we do this every Monday. So yeah, around
100%.
7
Yeah.
o'clock. Yeah, we do this every Monday. And yeah, thanks for the support. But yeah, I think it's time to call it. We've been going on for nearly 1 hour and 30 minutes. We've covered a lot of stuff. Hopefully, you guys can join us next week, Monday, and yeah, thanks for watching. Got anything else to say, Lewis?
So yeah, thanks for watching, everybody. It's been another good live. So yeah, we'll see you again next week.
Yeah. Thank you. Bye.
Thank you. Bye bye.